Hey everyone, I'm your host Tom Shaughnessy, and welcome back to Chain Reaction, a research-driven podcast that's a part of Delphi Digital. If you're not on Delphi's research portal, you're missing out on the critical analysis read by the top minds in the crypto space, so be sure to check it out. One quick housekeeping item: nothing said on this podcast is a solicitation to buy or sell any security or token, or to make any financial decisions. I may personally hold tokens mentioned on the podcast, and you can view our show notes below for our complete disclosures. With that out of the way, I wanted to give a quick shout out to our wonderful sponsor, eToro. The best way to be smart about trading crypto is to use the smartest trading platform. eToro is one of the largest trading platforms in the world, with over $1 trillion in trading volume on the platform per year. U.S. customers can trade the most popular crypto assets with extraordinarily low fees. And if you're not ready to trade yet, you can practice on the platform with their virtual trading feature. Best of all, you can connect with 11 million other eToro traders around the world to discuss trading, charts, and all things crypto. You can create an account at b.tc/eToro reaction or click the link below in your show notes. Just scroll down on your phone, click the eToro link, and it'll bring you right to their website. With that, let's jump into the episode. Hey everyone, welcome back to the podcast. Today I'm thrilled to have on Jake Brukhman, who's the founder of Coinfund. Jake, how's it going?
Hi, Tom. Thanks for having me. It's going well. How are you?
Good, thanks. Jake, thanks for coming on such short notice. Why don't you give everyone an intro about yourself and then maybe about Coinfund?
Sure. I've given this intro a bunch of times in different podcasts, but very quickly, my background is in mathematics and computer science. Spent a bunch of time in the hedge fund world in New York, namely like trading technology. Spent some time at Amazon in ad tech, and then spent some time in kind of research for private technology companies. And then was an early adopter of Bitcoin, got my first Bitcoin in 2011, and kind of fell down the rabbit hole around late 2013, and then started Coinfund as one of the first US-based and crypto-focused funds. Back in July of 2015, we mined some of the first blocks on Ethereum Frontier, among other things. And now have had almost 5 years of experience sort of investing in this space and watching it grow.
Time flies. Yeah, it's great that you were involved early. And I know you've given the intro a lot. I wish there was a way to just record them for people and replay them at this point. Nick, let's dive into Coinfund's thesis. You guys are really active. You guys hold a lot of events. You're really involved in the ecosystem. Mm-hmm. I guess it makes sense just to talk about what is Coinfund's investment thesis?
Yeah, well, I think this is, I think we arrived at our thesis through this long period of time of just being in the market and watching it grow. And as a matter of fact, we're in our second fund. Our first fund was very, very much focused on digital assets themselves, whereas, the strategy kind of changed for the second fund. And so, it took a little bit of time to come around to what is it exactly that is happening here and what are we investing in? And I think we finally have found a way, of articulating that. And so what we say is primarily the core focus of our fund is to invest in this thing called a decentralized network. And, what does that mean? Well, it means taking peer-to-peer technology, and often these technologies are they allow users to transmit value. So it's more evenly, you can even call it a decentralized value network, and that would probably be a better name for it. But the long story short is that these networks are starting to provide different kinds of services to folks. And in the early stages of these networks, we're seeing very low-level digital services. We're seeing decentralized network provide storage, computation, video transcoding, things like domain name registration or different kind of asset registration. We're even seeing things like virtual land. And I think over time, this extends to other things more along the lines of what Uber provides, what Airbnb provides. And namely, those are marketplaces that provide different kinds of services for people. And our core thesis centers around the idea that these networks are going to be extremely disruptive to the way that those kinds of services, and eventually more and more services and more marketplaces, how they're provided to users over time, how they're governed, and and how they're structured. And namely, there's this transition going on there from having private companies be the providers of these services and marketplaces to completely decentralized networks that are governed by its users and stakeholders to being the providers of that network, of those services, excuse me. And the really interesting thing that I think we have come to is that it's the value of this is not really in the long-term operation of these networks, but rather the value is in the transition from the traditional ways that these services are provided to these decentralized ways that these services are provided. So fundamentally, we invest in decentralized networks, and additionally, we invest in what we call the key enabling infrastructure of those networks, which look today, very much like traditional companies that are giving, banking services, custody services, node infrastructure services, secondary market trading services, and basically like all of the services that enable teams to build these networks and for those networks to bootstrap and operate effectively. So that's kind of what we have arrived at Coinfund for what we invest in.
It's an incredible thesis, and it definitely sounds like it's been hardened over time. Before we get into the different lifecycle investments that we're going to talk about, I'm wondering, has your thesis changed or adapted since you entered the space, actively 5 years ago, or when you bought your first Bitcoin? I'm just wondering, I'm sure the investments have changed, but I'm wondering if any of your views on the investment thesis or Coinfund's focus has changed over time.
Absolutely. Even just Coinfund itself as a statement of how do I engage the blockchain space has kind of evolved over time. Like, I'm an engineer. When I first saw blockchain, my first inclination was, hey, I should create a tech startup and build a product in this space. But what I quickly, surmised is that this technology changes so quickly, and it's so early in the innovation cycle of blockchain technology that, a lot of folks that started companies and kind of took a strong view of how this technology would develop, they ended up not succeeding because of the early and iterative nature of this thing. And so, I like to say that Coinfund was sort of the strategy that I arrived to say, like, in these extremely early stages, how do we capture the value of this stuff? Well, actually, we diversify across a lot of different technologies, a lot of different exposures to different areas. And then over time, we arrive at a more concrete strategy. So like I already mentioned, the first fund was very, very heavily focused on digital assets. And that's fine. Like, you can have a fund today where you want to just sort of trade, liquid cryptocurrencies and things like that. And that's kind of where we started. But ultimately what as we came to the conclusion of like, what is it that we're investing in, then the way that we invest has changed over time as well, right? And so once we have identified that, we're investing in a decentralized network, then we started thinking more along the lines of like, what is the analogy of the life cycle of that network to like the life cycle of a company? What does it mean for a network to be early stage? What does it mean for a network to be, where's the series A of that network, right? And when does that network go public? Almost like if you want to draw on kind of like the traditional company life cycle analogy. So absolutely, a lot of that changed from the early days and continues to change as people solidify what that life cycle looks like.
Yeah, it must be interesting going from Fund 1, liquid investments, to Fund 2. I know it sounds like a natural progression, but it must have been like a serious, change in the job, right? You're really spending a lot of time on the intricacies of early stage projects, whereas it sounds like Fund 1 was more focused on the giants in the space, Bitcoin, Ethereum, et cetera.
Yeah, Fund 1 was, it definitely held a bunch of kind of early assets. Now, I have to say, from the beginning, it was actually not very much focused on Bitcoin at all. We sort of saw Bitcoin as the first application of a technology that would continue to iterate and continue to produce different kinds of digital assets. And I actually had this weird experience where I pulled up that old white Coinfund white paper from 2015 the other day, where we didn't even have the concept of a smart contract platform. Like that was just like not a thing at that time. Like everything was understood in terms of cryptocurrencies. But the point is that even in that early document, we sort of foresaw that there would be an explosion of these things. And that's ultimately, what happened.
That's incredible. So you mentioned earlier about network, like the life cycles of these networks and investing. I want to dive into what you mean there, and then we could dive into how this differs for equities and more liquid investments and gen mining. But what exactly is network lifecycle investing? Is this like Series A versus seed investing, or is this really intricate to the section of the network that you're growing?
I think it's just us trying to make sense of like the different stages of networks. And of course, this is not a precise science. This is sort of like a heuristic and an approximation. But based on what we have seen, and at this point, we've seen hundreds of networks come onto the market. What does that look like? And what that tends to look like is first, a couple of folks have an idea. They write a white paper. These days, the first sort of stage in the life cycle is that they start a private company whose job it is to flesh out the design of the network, architect it, and start to put it into production. And of course, most of these networks are decentralized, right? So they need kind of a supply side of, in some cases, it's just validators who are validating blocks. In other cases, it's supply side providers that are providing like resources like storage or computation or something like that. Going as far as to say, like, maybe in some networks, providers are humans who are validating the humanness of other members of the network, or they're upvoting social media and curating, right? Whatever that supply side looks like, it needs to be bootstrapped, right? In a proof of work network, you need a bunch of people to roll out machines and start mining. In a proof of stake network, you need a bunch of folks to stake some of the asset and create the security of the network. And so there's this kind of middle stage where the network is, maybe it's out in production, but it's bootstrapping. It's requiring these like third-party supply side people to add a little bit of resource, add a little bit of time, whatever that network is about. And then, and only then, does that network become kind of usable to the consumer of that service. And that's when you go into the latter stage, which generally speaking looks like the service is now being provided and the asset of the network or the assets of the network, and usually there is one, are now liquid and trading on the markets and sort of giving people exposure, ideally, to the success of that network providing that service. And so that's all we mean by that. And then the question becomes, like, as an investor, what is the right way to invest in that, early kind of pre-seed private company stage? What is the right way to invest in the bootstrapping stage? And then what is the right way to invest in the public asset stage? And the way that our fund kind of approaches the answers to that question defines what our fund strategy is and what our fund structure is.
That's super interesting. So, a lot of people think about the supply and the demand side as a chicken or an egg problem that kind of has to be solved like from day one. But it sounds like what you're describing, and it's obvious talking, but it's interesting, is that we can have the demand side later. We could solve the supply side first. You just have to make sure you invest at the right time. So is it safe to say that the supply and the demand sides can happen at different times and that kind of dictates when and where you'd invest? Or is that too much of like a generalization?
No. I actually think that in blockchain, in our industry, like, a lot of folks have taken the position that is completely countercultural to the traditional position of startups. Namely, in the traditional position, you say, you notice a problem, you notice demand, you build a product, you meet that demand, you solve that problem, and that gives you an economic reward, right? And in blockchain, people have sort of, and duly have been criticized for this. They said, no, actually, what we can do here is we can build stuff first. And then that stuff will create these efficiencies that over time will just accrue users whether they like it or not. A lot of people don't like that because it sounds like what's that cliche people use? They say, oh, if you build it, they will come. And a lot of times people in the traditional world, they build products, but of course the users don't come. And so why should it be any different in blockchain? But what we see is, that of course this chicken and egg problem has two sides. You have the supply side and the demand side. And what we have seen decentralized networks do so far really effectively is to use economic incentives of digital assets to very, very effectively curate supply sides of things, right? So you now have the biggest supercomputer, which is like Bitcoin miners, right, in aggregate. That's a huge supply side, doing a momentous like computational task. Any proof of work network is another example of that. If you look at the LivePeer network, one of our favorite sort of like very decentralized systems to study, these guys have created a very novel crypto economics for their token that has attracted a ton of supply side people to provide video transcoding services and to really take an interest in that and to put a lot of hardware toward that task. If you look at social media, right, things like Steemit was like the first blockchain company to accrue 1 million, I dare say, like mainstream users. How do they do it? Well, they incentivize those users to post articles by giving them cryptocurrency rewards. And, they got pretty far doing that. So what we see is that the supply side bootstrapping has been an awesome experiment where with actually like a ton of success, right? But we have not yet gotten to the demand side, which I think comes later. And part of the challenge in the demand side is like you have to put these products in front of mainstream users who are used to a very highly curated, high quality experience. And we're just not there yet in blockchain. And so I think once folks have, or projects in the space sort of figure out how do you use those same kind of incentives to bootstrap the demand sides of these markets, then things really take off. And if you want to see some interesting experiments in that realm, take a look at something like Cent, which is a company which I advise and am personally an investor in, which is trying to use, again, economic incentives to sort of allow users to create great content and curate great content. And then there's like a ton of other projects in a similar area. One I've been looking at recently is 2100.co, where you kind of issue almost like personal equity in people's Twitter handles and stuff like that. And then you can interact with them in a social media way. But the point is that your interaction is driven by a lot of these like token incentives that come from owning the stock of different like crypto personalities or something like that. So in short, I think the supply side experiment has been great and the demand side experiment is kind of ongoing.
That's a great way to look at it. Yeah, I hate when I'm talking to people and they're like, what does this solve? And the whole buck stops there. I'm like, look, we're creating literally a new world. We're going to have plenty of problems to solve. We already do, as we build that out.
Indeed. I think it's just early, right? Like, and people are very impatient. They want to see results right away. But this, the truth is that you have to cultivate results and you have to measure and make mistakes and, kind of come back and grow it over time. And in blockchain, things tend to move pretty quickly. And so people expect results quickly. But the reality is we're just another technology space and we're subject to the same laws of the universe as everybody else.
Of course. And you mentioned that lifecycle investing is somewhat of an approximation. I mean, when you're looking across the three different buckets that we kind of have for the discussion, like we have equity investments, we have gen mining, and then we have the liquid opportunities, how different is it, or how much more or less time do you have to spend, because this is an art at this point, figuring out where you are in these buckets for a project? And maybe a more specific question would be, do you invest in different cycles for each different bucket, or are you aiming to invest in the same cycle but across the different buckets? I guess might be a better question.
Well, so that's actually an excellent question, and I think this is where, in some ways, like being a crypto fund is highly, highly competitive with other approaches to investing that are more classical. So, for example, if you're a straight up VC fund, your asset is equity. And so if you believe in the network life cycles that I sort of outlined, then you're going to be in that early stage, investing in the early stage equity of those private companies that are building those networks. And of course, that's fine. But the problem with that is it's not clear, that value of those networks necessarily accrues in that equity. This is especially true in the decentralized world where, like in 2014, we saw a bunch of VCs fund startups that were building networks, but all of the value accrued in the tokens. Speculative value, but value nonetheless. And a lot of those early VC investments weren't that successful. So if you're just a VC, you're kind of, pigeonholed into that equity bucket. If you're just a hedge fund, you're sort of pigeonholed into the liquid trading bucket. You're like more likely than not to be holding and trading Bitcoin, and you're less likely to be concerned with the fundamentals and like long-term value of the companies and projects. And you're just more like, you're just more making sort of like technical analysis calls or trading calls or something like that. And when you're a crypto fund, you can actually sort of move the dial and say, I caught this network really early, so I'm going to invest in that equity, and then later maybe that'll convert to tokens, and I'll, modify my strategy there. Or you might say, like, I think this equity round is really overpriced for what it is. However, if this team makes it to production and actually puts a network into production, I might be able to use technology. I might be able to mine. I might be able to use generalized mining or active network participation to sort of get access at that second stage, but now minus the sort of execution risk that you would incur as an early stage investor. Or you just wait and maybe you buy an asset on the secondary market later, but your view is a fundamentally long-term view on investing in that product, and not necessarily like the same divorced view that a hedge fund would have. And so a crypto fund, in my mind, like, has the ultimate optionality kind of across these things, and therefore, can manage its risk arguably better than other structures.
We're going to continue this conversation shortly, but first, some quick info from our amazing sponsor, eToro. For a lot of crypto fans, it's hard to find one place where you can trade, plan, and discuss strategy all in one place. Turns out Europe has had a platform that can do this all along. It's called eToro, and it's the world's #1 social trading platform. Not only does it give you access to the most popular crypto assets on the market, but its virtual trading and discussion features let you discuss and test strategies with a community of over 11 million other traders. And the headline news is they've officially launched in the USA. To get started, visit b.tc/eToro reaction to make an account, or just scroll down in the show notes and click the link below. With that, let's jump back into the conversation. That's an incredible overview, Jake. So, I mean, just to summarize, you're basically saying that like your fund and crypto VCs like you basically just have more tools to take advantage of early stage investments than normal VC funds that are just, investing in equity.
That is what I'm saying, and that would be my position. Yes.
That's awesome. I mean, do you think that down the line, your fund or the projects you invest in will eventually be, say, acquired by, PE firms or even stakes taken by larger VC firms if they do future equity rounds? I mean, it seems like you can get in early and then take advantage of, traditional, mega VCs who have their arms kind of tied behind their back a little bit.
Again, I think a crypto fund that's looking at highly crypto native projects, I think they have more flexibility. So, I would be kind of inclined to agree. If you look at our, a great case study that we have done at Coinfund, and, it's basically like the LivePeer network, right? So love the team. They're here in New York. We're also based in New York. Have known the founders at LivePeer, Doug and Eric, for a number of years, even before the LivePeer white paper. You had some early stage kind of more traditional investors go into their early notes. Those guys helped to fund the product early on. Then there was like a 2-year sort of execution period where the team worked very, very diligently and put the network into production. It finally got put into production summer of 2018. And at that point, we went and we became the largest software miner of the live peer token distribution mechanism, which is called the Merkle mine. And then we got, a fairly significant stake in the token network. And then we were able to sort of lower our, exposure to the execution risk, whereas the early investors took that on. And we were also able to optimize the pricing for the tokens by using technology to accumulate them. Now, that all being said, that was sort of the generalized mining approach to exposure in LivePeer. But then what happened next is that LivePeer went out for a Series A, and they said, "Hey, like we've built the network. Essentially, we want to have a great set of investor partners that help get us to market." And then we became equity investors in LivePeer at Series A, right? And so, like, that's the ultimate optionality. Like, you can have that early exposure as an illiquid investment. You can have the technological exposure to the token. Once you're involved in the network, that you're kind of well positioned to understand why the Series A opportunity, might be a great opportunity because you understand how the network works quite well, and then you can see that it's operating. And so again, like, there's this just high degree of optionality that you get, I think, across these stages that allows you to manage risk better, and that allows you to build relationships both with the technology over time as it changes, and also the teams of people that are building it.
Yeah, that's incredible. I mean, the network lifecycle investing thesis you have is pretty cool because it also goes back into your thoughts on, the chicken and the egg and supply and demand. Because, I mean, you're not only supplying capital here, but you're also participating in helping transcode on the live peer network. So you're really helping, the demand side there. I guess in a way, I mean, you're not putting videos up that need transcoding, but you're helping to secure the network. So that is a pretty interesting dynamic, Jake.
Yeah, I agree.
And just moving on, Jake, I mean, to, overall VC thoughts. I mean, what are like some of the biggest difficulties for you as a VC in the space? I mean, I feel like VCs of the past had to do a lot of hand holding. Like we're looking at SoftBank with WeWork with Adam Newman. It just looks horrible. But I mean, in your case, you have to deal with a decentralized base of like global stakeholders here. It's not just, one founder you can call up on the phone and say, "Hey, I think you should do this. I think you should do that." I mean, are there any issues or difficulties when you try and get more actively engaged in your investments?
That's a great question. I typically don't think of myself as a VC, although I do a bunch of VC-like things day to day. I see myself as an engineer who became an investor, and I don't see Coinfund as a VC fund. As I said, I see us as a crypto fund. So to say that we are a VC, I think we would move away from that framing, but you're absolutely right in the sense that we're definitely investors, and we're definitely involved in, seeing these deals and investing in them and kind of understanding the products very deeply that these teams are building. And of course, those products are really novel and new and sometimes unknown, right? Because they are in this form of like decentralized networks. So, one thing that I think traditional VCs definitely are challenged by in blockchain is the technical nature of it, right? So when you're talking about just a blockchain base layer, this is a technology that works on, distributed systems, computer science. It works on kind of mathematically formalized algorithms that create consensus. It involves cryptography. It occasionally involves quantum resistance, which are all like very advanced and very deep topics. And without spending a lot of time like being an engineer or being a computer scientist or being immersed in those areas, I would say that the trap that investors fall into is that they come with some traditional sort of technology investing experience. They take the heuristics from that experience and they apply it to blockchain, and then it doesn't work, or it doesn't work as planned, because I feel like in many different cases, like blockchains just or opportunities in the space have sort of gone beyond those heuristics. One of the major drivers of that disconnect, I would say, is just very simple. It's just the earliness of the pricing of all these assets. So, if you think about being a trader or analyst or researcher at a traditional, investment firm that's looking at stocks, and you have like some event in a stock, usually those events are like very well understood. It's like, oh, we had a merger, or we had a merger fail, or we had a market dislocation because of some fundamental factor. And when you're looking at the markets in blockchain today, what you're seeing are a bunch of things that look like stocks, and they move like stocks, and they have candle charts like stocks. But as a matter of fact, they're the vast majority of them are speculatively traded and are unpriceable. And so people love to like come up with like narratives around, hey, why did Bitcoin drop 20% today? But almost certainly, like, all those narratives are really are quite false, right? Or just unknowable, or just have no reason behind them. And so, I think we fall into this trap where we bring our kind of like traditional instincts into this space, and then we sort of forget what we're dealing with, which is that.
Yeah, I couldn't agree more. I mean, I've fallen into that trap a few times, just trying to apply maybe too much of the equity research background to crypto. I mean, there are edges there and advantages, but there also are pitfalls there, like you said, because the frameworks don't apply, or you have to change your thinking, or not everything has a real reason underpinning a move, especially in Bitcoin.
Mm-hmm.
Jake, just closing out, looking ahead to, we're getting towards the end of the year. We're looking forward to 2020. What are you most excited about in the space? I mean, is it generalized mining? Is it, the launch of, there's over a dozen new layer ones that are going to launch over the next year or two, Filecoin set to go live. Like, what are you most excited about going into the next year?
Yeah, sure. I'll tell you like a couple of areas that I spent a lot of time in this year, and that I'm excited about. So one area that I spent, very early on, maybe the first quarter of this year, like very deeply, is the space of non-fungible tokens and digital art. You might know, and it is publicly stated, that we are investors in Dapper Labs, together with our platform partners at Venrock, who led that round last year. And just a few weeks ago, Dapper announced their Flow blockchain. So I spent a bunch of time in that space, and what I see is, again, this situation where there's a lot of great supply side. There's a lot of people building collectibles. Check out Block Cities. There's like Clovers. There's people tokenizing cards with domain names called Marble Cards. I just talked to these guys yesterday, right? People building virtual worlds, where today they are like the number one use cases for displaying these digital arts. And Decentraland and CryptoVox, those are obvious examples of that. So I think there's a ton of people creating assets, and it's still very early on the demand side. So actually, one thing that I did this in Q1 is I started my own digital art gallery called firstedition.art, in an effort to maybe help to start that flywheel of buyers who are like buying and collecting these artworks. That's one area. I think that's going to be a huge area. I think there's a technical trend, beyond blockchain, that shows that digital assets are highly saleable and generate like billions of dollars of revenue. Another much more technical area I spent time in this year is just thinking about scalability, right? And how does, when Nouriel Roubini goes up in front of the U.S. Congress and like just point blank says, hey guys, like blockchains don't scale. Well, is there any truth to that? And if you actually go and if you actually look at what base layers are doing, what are the innovations in base layers, what are the innovations in POS, you actually see like a bunch of progress and scalability there. And then when you go to layer 2, and these would be like state channel projects and maybe more notably like side chain technologies, you see a ton of progress being made in scalability. Like the ZK rollup stuff Vitalik has described, you're talking like 2000 TPS, 50x better fees, like much better decentralization characteristics than previous solutions to scalability. And so I've actually become quite bullish on the idea that we can get to the next order of magnitude of scalability, and definitely serve like an order of magnitude more people, and maybe even more than that. And that buys us time to become even more scalable later. And so I've done a bunch of research this year on those kinds of technologies. And then, of course, related to that is this idea of like DeFi. Like, is DeFi a thing? And I kind of take a moderate view here. Like, I know there's a lot of Ether, let's say Ether bulls, right? They're super excited about DeFi, and so am I. But I kind of think that there's a bit of a cognitive dissonance between, this idea of like scalability and composability of DeFi, which is sort of the killer feature described by Jesse and Dennis at A16Z. Now, scalability and composability are kind of at odds. And in Ethereum 2.0, what that looks like is, this really slow time to sync between different shards of the chain. And so what I think is like, Ethereum DeFi is a great like prototype and demonstration of how of what DeFi could be. But ultimately, we've sort of saturated the demand side there with like Ether enthusiasts and traders. And what we really need to do is we need to get to the mainstream users, and a bunch of companies, namely like wallets, crypto banks, and stuff like that, are trying to do that. But I think the long-term view on DeFi or open finance or whatever you want to call it is that it actually lives on a bunch of different chains or side chains and is highly interoperable together. But that's a super exciting area, because what you can do is you can take some of those micro financial services that DeFi provides and put it in front of a retail user and say, hey, your bank account, you're earning like 2%, you can earn 8% here. And of course, there's a bunch of problems with that. There's no brand trust. There's still a bunch of smart contract risk and all this stuff. But even like risk adjusted, I think it's a value add ultimately, and ultimately will get people into these kinds of technologies.
Yeah, I couldn't agree more on your points, especially the composability side. I mean, I have very strong opinions that I think that composability, makes major moats on blockchains. But to your point, it definitely is at odds with scale. I guess closing out, Jake, when do you think we hit that inflection point? I mean, I'm looking at your art site now. It's incredible. I'm hearing about all the composability building blocks being put together. There's over a dozen teams working on scaling on Ethereum. There's 7 implementations of Lightning on Bitcoin. When do we get to the point where this is simple, this is easy to use, people don't even know they're using it? Like, do you think that's 6 months out, 5 years out? When do you think that happens?
I don't know. I wish I knew. If I knew, I would be like a rich man, because I would take out a prediction market on that event and bet on my knowledge. But I do think that it will, it tends to come sooner than we think, right? And it tends to come from these almost unexpected and unpredictable events that just kind of, some app comes out of somewhere and just finally nails it and then just starts growing like crazy and becoming a funnel in users. I think one of the probably the highest probability areas of that is probably things like crypto banks. Like I said, when you can offer a cold hard financial innovation to a mainstream user, like money, like better rates, that is a very strong incentive to go into a system. And I've had some success showing some of these wallets to like my family members who are not technical, and they got it and they were able to use it. So that's great. We're making progress there. And I also think that things like decentralized data, decentralized identity, self-sovereign data, self-sovereign identity, things like what 3box is working on, which is another investment that we made a few months ago in a phenomenal team. This is a kind of value proposition that's operating, and this is very unusual, but it's operating in the intersection between being very useful for crypto native applications for dApps, like decentralized identity is like a huge hole in the space that needs to be filled. And at the same time, we have this larger tech trend where people are saying, hey, wait a minute, I need privacy in my digital life. I need security in my digital life. Companies don't want to hold user data because they now see it as a liability. And there's a bunch of consumer tech sort of looking for solutions of like, how do we put private data into a decentralized network? So we remove that liability from ourselves and let the users kind of worry about it. So those kinds of things that fit into the larger trends of society, the larger technology trends, the desires of people to make a better rate or hedge against, what a lot of folks see as like financial collapse, right? I think those are kind of like higher probability things. And just like as a last thing, like one of my favorite projects in blockchain is what has been built at YouNow, which is basically Props project. And this is one of the first projects that has a Reg A plus on their token supply and can now very freely interact with retail users. But more to the point is the fact that this is a kind of a new way for people that are on social media to actually get compensated for their time and for their engagement in a fair way. And those sorts of like disruptive but highly competitive technologies, like when you compare that to like a YouTube or something, I think also have a pretty high, probability of making it in.
That's awesome, Jake. It's great talking to you because the listeners probably now like they have a laundry list of projects they have to look into.
Awesome. Yeah. Thank you. Thank you very much for your great questions as well.
Yeah, I appreciate it. And Jake, where could people follow you, learn more about Coinfund? Just, I guess, share a couple links.
Absolutely. Please follow me on Twitter. My handle is JBRUKH, Jake Brukhman. Coinfund is at coinfund.io. And if you want to read our blog where we have a lot of our investment theses and a bunch of public research that we've done, that's blog.coinfund.io.
Awesome. And for everyone listening, all those links Jake mentioned, along with all the projects he mentioned, I'll be linked in the show notes as well. Jake, thanks so much for your time. I really appreciate it.
Okay, Tom, thank you.
Hey, everyone. Thanks for listening to the episode. If you can go to iTunes and hit subscribe to the Chain Reaction podcast, it'll go a long way in helping us reach new listeners and help support the show. Thanks again.